Yeah, let us do a very preliminary discussion on risk and return. Right, this will help us to give a start to portfolio management. But before that, let's try to understand what is the relationship between risk and return. Let us put it in this way. Let us say you have rupees 1 lakh to invest. Can you tell me which are the different avenues where it can be invested? So let us say the year has come to an end. You have been able to save your money, and at the end of the year you realize that you have saved a lakh of rupees, and now you are planning to invest this 1 lakh rupees somewhere. Can you tell me which are the different avenues, which are the different what we can say investment products that you can select out of this rupees 1 lakh? Let's try to make a list of what are the different possibilities over here. What do you say? The first, of course, is the age old fixed deposit, isn't it? If you have a lakh of rupees and you can always put it in a bank, safely you can park that money in your bank by opening a fixed deposit. I personally believe this is the favorite, Indian favorite investment product. One can consider that to be a fixed deposit. But let us say you are a slightly dynamic, you are not interested just in fixed deposit. Can you think of different other places? What do you say? Nowadays, even mutual funds have become quite popular. So you may suggest that, okay, I may invest in mutual funds. If you are saying fixed deposit, the other possibility is maybe a PPF, right? A public provident fund. You may even invest your money over there. Or maybe post office savings, right? There are different types of schemes available in post office. Maybe you may put your money even somewhere over there. Or, of course, you can put your money in shares. What do you say? After all, if we are discussing portfolio management, we can't say that we will not put our money in shares at all. So that is also one possibility where you can put your money. Yes, even bonds and debentures are also available. Yes, so that can also work as an alternative. What do you say? Let us say corporate bonds and debentures. I'm including that in bonds itself. So corporate bonds, that is also possible. Yes, life insurance may also come to your mind, but I will not put that over here because life insurance or the ULIP plans, although they are saying it is a unit linked investment plan, but to be very honest, we should keep insurance and investment separate. So I'm not putting those products over here. Insurance is altogether different. Although we do have money back plans and insurance from insurance companies also, but I'm not putting that over here because over there the main intention is insurance and not really investment. So let's not consider it as a pure investment product. So that's the reason I'm not putting that thing over here. Anything else? Of course, you can put your money in gold. What do you say? Yes, gold is giving phenomenal return in this particular year. So yeah, one may even think about investing gold as well, or maybe silver also. But I will just put it gold as a representative over here. What else? Where else can I put my 1 lakh of rupees? What do you say? Real estate can also be one thing that may come to your mind, but see, I have just put it very clearly. We have 1 lakh of rupees. In simply rupees 1 lakh, I mean, no real estate is going to be available. But still, for the sake of it, as one of the investment avenues, I may say real estate. Although, be very clear, you won't get anything in 1 lakh, and if you are getting something in 1 lakh, then I am also very much interested. You can definitely give me the necessary information that so and so property is available for a lakh of rupees. I am very keen in buying it. So yeah, but yes, for the sake of it, since we are making a list of different investment avenues, it makes sense to put real estate too. I believe this is a good what I can say, a list that we are having, right? It's a good list that we have. Let's try to discuss it. Let's try to discuss. What I want to do is, yes, we come to the main point now. What exactly are we planning to do? I'm putting here risk and I'm putting over here return. Similarly, I say risk here and return. Okay, and let's put them in three categories. Okay, high, medium, and low. I'm not asking you an exact percentage that if you put your money over here, then what is your exact percentage of risk? I'm not saying that. Or what is the exact percentage of return? No. But on a behavioral basis, I mean, what's the emotion which is associated with that product? When we talk about a particular investment product, what's the first thing that comes to your mind? Whether the return will be low, moderate, or medium, or high. What is coming to our mind? Let us discuss now in that way. Okay. So let's take each of the investment products that we have put over here and let us understand how will you, or rather, what value will you put against the risk and the return? That will make the discussion very interesting. Let's do it. Okay, tell me. Uh, when you are saying fixed deposit, tell me. When you say fixed deposit, what comes to your mind? Risk, lower side, moderate, or higher side, right? So, of course, we will consider the risk to be on a lower side. Fine. So, we consider risk to be low. Tell me, what will be the return that you will get from a fixed deposit? The returns on fixed deposit have dramatically fallen in India. I will put low over there. I hope everyone is fine with it, right? Fixed deposit, risk is on a lower side, return is also on a lower side. What do you say, mutual funds? Now, see, we have to put all these things on a comparative basis. There can be certain mutual funds which can be very risky. There can be certain mutual funds whose risk will be really low. But on a comparative basis, if I compare mutual funds with fixed deposits, right? If I compare mutual fund with fixed deposit, I want to know what will be the return, what will be the risk, right? It seems that the risk is turning out to be moderate and even the return will turn out to be moderate, isn't it? I'm comparing this with mutual funds. Let me skip PPF and PO savings right now, the post office savings right now. Let me jump directly to shares so that you can really compare the three products really well. Fixed deposit, I'm saying low risk. Mutual funds, I say moderate risk. But if I'm investing in shares, of course, my risk is on a higher side. But if my risk pays off, then my return will also be on a higher side. I hope everyone agrees with it. I will get a return higher than a fixed deposit. I will get a return higher than what I will get in a mutual fund, isn't it? Okay. What do you say for a PPF? It is a no-brainer. I don't want to even discuss this. Obviously, a provident fund, public provident fund, which is managed by the government. One can even say no risk at all. But still, since for the sake of it, I can say the risk is low and the return, of course, will also turn out to be on a lower side. Yes, it might be slightly higher than the fixed deposit, agreed. But then we know in PPF there is a limit of maximum that can be invested by us. So beyond a certain amount, you will not be able to generate the return. That's the reason. Post office savings also I'll put in the same category only, right? We can say it will turn out to be low. On the other hand, corporate bonds, yes, if I compare corporate bonds with fixed deposits, then the return and the risk is on a moderate side. But still, I can say that the risk will be low over here and the return will also be low. Because corporate bonds I also have to compare with mutual funds. So if corporate bond is compared with a mutual fund, then the risk comparatively is low. As I said, we are doing it on a comparative basis. Gold, yes, that's an interesting one. What do you say? You are putting money in gold. Risk, of course, the risk turns out to be on a lower side. Very natural. The risk that you are taking by investing in gold is very low. Gold is actually considered to be an international currency. International currency. You know what that means? If you are having a piece of gold at any part of the world, you can encash it. For example, if I'm in a foreign country and my wallet is full of Indian rupees, I may or may not be able to convert the Indian rupees into the foreign currency. It's possible that there may be some restriction. But if I am having gold, I can just go to any gold shop and I can encash that gold. That's the reason we consider gold as an international currency. It is accepted worldwide. Okay, the prices of gold are determined by, say, international, what I can say, forces of international supply and demand. The price of gold will be initially determined in dollars, and yes, then it gets converted into Indian rupees, applying the then prevailing exchange rate. So it is internationally priced. So the risk on case of gold is turning out to be on a low side. What about the return? Now, please understand, when I will say gold and when they are saying return, I will put return as low, although you will of course disagree with me. In this particular year, gold has given a phenomenal return. I do agree with that. Remember, whenever the world economy is in recession or is expected not to do well, the prices of gold will start rising. It's very natural. See, if I have money and let's say I have a risk appetite, then I will basically like to put my money in stock markets because stock markets will normally give me a higher return. But when I come to the conclusion that the economy is in the recession, when I come to the conclusion that the stock markets will not give me good return, what happens is I will pull that money out of the stock market. Now I will have to invest it obviously somewhere. And since there is a lot of risk associated with the stock market, I will park my money in gold. Normally, you will observe that when markets are not doing well, by markets I mean stock markets. Normally, you will observe this that when stock markets are not doing well, it is gold which is doing extremely well because a lot of people are pulling their money, especially international investors are pulling their money out of the stock markets and investing that money in gold. And that's the reason we see a phenomenal rise in the gold prices. But this will not continue in the long run. Sooner or later, the economy will pick up, and finally, the investor will realize that better return will be now available in the stock markets. That's where they will withdraw money from a safe asset like gold and invest it in the stock markets. That's the time when the gold prices will cool down and the stock market will start giving a better return. This is a phenomena which keeps on repeating itself in a cyclical manner. And that is the reason there are certain exceptional years where gold does really well. But when I say return over here, I don't mean return over a period of, let us say, 1 year. See, if you are doing portfolio management, then you have a long-term view. By long-term view, I mean, let us say the next 10 to 15 years. That what will happen in the next 10 to 15 years? All the analysis that has happened on the stock markets reveals one thing, that when you calculate average return for the past 15 years, stock market always gives a positive return. So that is the reason. When I say gold, I will put return as a lower, because when you will calculate return over a 10-year period, when you calculate return over a 15-year period, that return will turn out to be less than that of the stock market. So yes, there are certain years where what I have put on the screen you may disagree with, and I absolutely admit it. The current year, for example, is a year where gold is definitely giving you a higher return. I admit it, but I am discussing this on the basis of what the long-term trend should be. I don't want you to be under an impression that gold will always give a return better than stock markets. The moment I tell you that gold will give a return more than the stock markets, you will become less interested or not at all interested in portfolio management. You will be like that, okay, let me park my money in the in gold and life is set, isn't it? But that is not so. That's the reason return I will put on a lower side. You know what happens in India? Most of the gold that any household will have is actually gold which has been accumulated over generations. Let us be very honest with it, right? For example, at the time of marriage, there's a lot of gold which exchanges hands. And then there are so many households which are of the view that on certain auspicious days, certain amount of gold has to be purchased, or on certain occasions. I know there are certain households that on every birthday of their child, they will keep on buying a little bit of gold. So what happens is, over a period of time, a lot of gold is accumulated by the household. And then this gold is transferred from one generation to another. A very typical Bollywood movie scene. What do you say? A very typical Bollywood movie scene. What happens in that typical Bollywood movie scene? What happens? Tell me. A newlywed bride say comes to the house for the first time, and then you have this mother-in-law. I'm sure you are able to visualize what I'm trying to say. The mother-in-law is removing her bangles, her kangan, for example, and giving it to the new bride and telling the new bride that this was given to me by my mother-in-law. So that's what I am saying. A lot of gold has been accumulated over a period of time. So, you know what happens when you and me sell gold? That gold has been purchased maybe by your grandfather or maybe your great great grandfather, right? It is that person who has purchased this particular gold. You as a person has not spent anything to buy that gold. So when I sell that gold in the market and I get a tremendous amount of money, I am extremely happy. I am of the view that I'm getting such a good return out of my gold. But come on, this gold was preserved by your family for 3 generations. Whatever return you are getting, divide that by 3 generations. Let's say divide that by 300. Then there is hardly any return that you are getting from, right? Similarly, real estate, yes. Again, here also a lot of people have misconception that the money invested in real estate is, very safe. Let me tell you, it is not so. When you put money in real estate, you are taking a high amount of risk. You know why? Because of the illiquid nature of real estate. For example, let us say you are buying an office or you are buying a flat and your plan is to not use it, but remain invested for a few years as an investment. Maybe during those few years, you may rent it out and earn some rent income also, fine. But your ultimate plan is to sell that particular real estate. I do admit that when you will sell the real estate, yes, you can get a good return. So, return also, I'll say, is on a higher side. But why is the risk on a higher side? Why can't I say that the money invested in real estate is safe? As I said, real estate suffers from it being illiquid, right? Its liquidity is on a lower side. Just a second. The problem with real estate is poor liquidity. That's the issue over here. If I plan to sell a particular property, I'll not be able to sell it that easily. For example, I'm in urgent need of money and I put my money in fixed deposit. I can go to the bank and break the FD. No questions asked. I can do that. I've invested in shares. I can sell the shares. I've invested in mutual funds. I can sell the mutual funds. I've invested in gold. I can very easily sell gold. But if I've invested in a real estate property and I am in urgent need of money, there is no reason to believe that I will be able to sell this property. For example, let us say you have invested in an office premise and now you are planning to sell it. So maybe you are talking to your broker. Let's say you contact a real estate broker and you tell the broker that, see, these are the details of my office and I plan to sell it. The real estate broker says, fine, I will, what can say, circulate this information amongst my database. And you know what happens the next day? The next day you reach your office, there's a long queue of people, long line of people. Starting, let's say your office is on the second floor. Starting from the ground floor, there is a serpentine queue. in the entire staircase till the door, right? The door is closed, of course, because the keys are with you. And you finally reach the premise. Someone tells that, see, this is the person who is the owner of this particular office. And then everyone who is standing in that queue is requesting you, please sell your office to me. See, I'm a very good person. I have so and so resources. Please sell this property to me. I'm ready to make a full payment right now. I'm ready to pay a little bit of premium for it. Will such a thing really happen? No, it will not happen. So if you're of the view that you just give one advertisement to sell your property and people will line up to buy that property, that will happen. So that's the reason I am saying that return will be high. I do admit it, but the risk is also on a higher side because selling that particular property is going to be that much difficult for us. Finally, look at the computer screen. Yes, please look at the computer screen. This is what you are getting. Okay, this is what you are getting. Can you tell me some relationship between risk and return? Looking at the figures that we have over here, can you have can you say some relationship between risk and return? Tell me. Fixed deposit, low and low. Mutual funds, moderate, moderate. Similarly, if I look at the last one also, real estate, high and are you able to develop a relationship between risk and return? Come on, tell me, what's the relationship? We are able to develop a direct relationship. This is the thing that I want you to understand. Direct relationship between, come on, tell me, a direct relationship between risk and return, right? Let me put it down. A direct relationship between risk and return. Everyone agrees with me. What do you say? Risk and return. I hope you are able to accept the relationship that I am developing between the two. What does that mean? It means if you want higher return, come on, you want higher return, you have to take higher. There is not a single product developed right now in the financial world which will take less risk and give you more return. No such product is available. So there's a direct relationship between the two. If you want higher return, you have to be mentally prepared to take higher risk. Okay. And if you are like that, no, I don't want to take too much risk. If you are like that, no, I want my risk to be on a lower side, fine. You can have a risk on the lower side, but you will have to compromise on the return. Okay, you cannot get best of the two worlds where the risk is on a lower side and return is on a higher side. That is not possible. In other words, risk and return go hand in hand. Okay, the term that I'm using over here is that the risk and return, they are friends, they are close friends. That's what I can really say. Risk and return, they go hand in hand. They will always accompany each other. You take slightly higher risk, you will get slightly higher return. You reduce your risk, you will reduce your risk. That is the importance of risk over here. Majority of the people who invest in stock market, they commit a very common mistake. And the mistake that they commit is their eyes are only on return. They never ask themselves that for that particular return, how much risk they are taking, right? What I will suggest is that the best starting point is always risk. Okay, the best starting point is always risk and never return. The return that your friend is getting, the return that your neighbor is getting, you may or may not be comfortable with the amount of risk they are undertaking. So many a times our eyes are only on the return, But once I plunge into that particular security, then I realize that I have taken risk much, much more than my acceptable level. So that's the reason. If you are doing portfolio management, if you are managing your own money or you are managing your client's money, the first question that you should ask your client is not how much return you want. First question that you should ask your client is, or try to understand with the discussion with your client is, or if you are managing your own money, then spend a little bit time with yourself and ask yourself, ask yourself how much risk, how much risk is fair risk for us? Okay, this is the question that you should ask yourself. How much risk are you ready to? You should not be a person who is not ready to take any risk and still you will invest in the stock market. Then the stock markets will make you highly nervous because you have selected a product which is way above the amount of risk that you can. This should be our starting point for the purpose of portfolio.